Ladies and gentlemen, stop everything you're doing right now and listen carefully. In just 2 hours, 120 minutes, silver didn't correct. It didn't dip. It plummeted 22%. That's not a normal move. That's not healthy profit taking. That's a deliberate, violent flush designed to shake out the weak hands while the real game plays out behind the curtain. Most people are staring at the red screen, panicking, selling, asking, what just happened? But I'm here to tell you, this isn't the end of the silver story. This is the trap being triggered. The paper markets just showed their hand again. Massive leverage, spoofed orders, margin calls engineered at the worst possible moment. While physical demand from Asia, from industry, from smart money stacking bars and coins is only getting louder. Today, I'm going to break it down crystal clear. Why this 22% drop happened, who's really behind it, what the charts and the spreads are screaming at us right now, and, most importantly, what you need to do if you own silver, or if you're thinking about getting in before the next leg rips higher. Because make no mistake, crashes like this don't kill bull markets. They set them up. Let's get into it. This 22% silver crash in 2 hours wasn't an accident. It was a textbook paper market shakeout. They flushed the weak hands so the smart money can load up cheaper before the real moonshot. Picture this. Silver ripping higher, pushing past $90 an ounce on the Shanghai futures, momentum building, retail piling in, leverage players riding the wave like it's unstoppable. Then, bam, in under 120 minutes, the price gets hammered straight down to the low 70s, wiping out $17 per ounce in a heartbeat. That's not a gentle pullback from overbought levels. That's not normal volatility after a parabolic run. That's engineered, calculated, and brutally efficient. The paper markets, futures, ETFs, derivatives, run on leverage, margin, and algorithms. When the big shorts pile on, they don't just sell. They flood the order book with spoofed volume, trigger cascading stop losses, force margin calls on overextended longs, and create a liquidity vacuum that sucks prices lower at warp speed. It's a classic flush. Hit key support levels hard enough to panic the herd into dumping, then scoop up the discounted physical while everyone else is running for the exits. Statistically extreme? Absolutely. A move this violent, this fast, gets labeled a multi-sigma event, something that theoretically happens once every few trillion years in a truly random market. But markets aren't random, especially not in precious metals. While the charts bled red and headlines screamed crash, the physical reality told a completely different story. COMEX vaults reported massive outflows, millions of ounces pulled in a single session as registered inventory drained at record pace. Global dealers scrambled, premiums on bars and coins spiked, and reports from Asia showed industrial buyers and stackers ignoring the paper carnage entirely. Solar manufacturers, electronics firms, even military contractors kept taking delivery, because silver isn't just a speculative play. It's a critical raw material that's getting scarcer in real form every day. This divergence is the smoking gun. Paper silver can be printed endlessly through futures contracts, naked shorts, and unallocated claims. Physical silver cannot. When the leverage paper longs get liquidated en masse, the price tanks temporarily. But the underlying supply crunch doesn't vanish. It intensifies. Those who sold physical during the panic handed over bars at fire sale prices to the very entities orchestrating the drop. Bullion banks, institutions, and smart money waiting in the shadows. Look at history. Every major precious metals bull market has these shakeouts. 1980, Hunt Brothers squeeze, 2011 peak, even the mini runs in between. The pattern repeats. Euphoria drives prices parabolic. Leverage builds to dangerous levels. Then a violent correction purges the weak, resets the board, and sets the stage for the next leg higher. The 22% drop didn't kill the bull. It pruned it. It cleared out the tourists, the margin gamblers, the paper-only believers who treat silver like a meme stock. Right now, open interest on futures is collapsing as positions unwind, but physical demand isn't following suit. Asian markets, even during holiday closures like Lunar New Year, show tightness. Western spot hovers lower, but bid-ask spreads widen, indicating real scarcity beneath the surface. The manipulators win short-term by crashing price and harvesting retail fear, but they can't stop the fundamentals. Industrial consumption exploding, mine supply flatlining, above-ground stocks getting vacuumed up. This is the setup. The flush creates the bargain, the weak hands exit, the strong hands accumulate. When the paper suppression lifts, and it always does, the rebound isn't gentle, it's explosive. Those who held through the storm, who stacked more on the dip, position themselves for the violent reversal that follows every engineered takedown. The game is rigged in favor of the prepared. The crash was the signal, not the end. Physical reality diverges further from paper fantasy every passing day. The smart money doesn't panic at red screens. They buy the fear, load the truck, and wait for the squeeze to ignite. While everyone's panicking and dumping, physical silver is disappearing faster than ever. Paper crashes don't kill bulls. They light the fuse for the next violent leg higher. Stay stacked. Right now, the screens are flashing red. Headlines blaring, crash. Retail investors hitting sell buttons in fear. Margin calls ripping through leverage positions like wildfire. Silver just got smashed, down sharply from recent highs, with that brutal 22% drop in hours still fresh in everyone's mind. The paper price on COMEX and Western exchanges tanked hard, wiping out billions in notional value, triggering liquidations, and shaking out anyone who wasn't prepared for the volatility. But zoom out from the futures ticker and look at what's actually happening in the real world, and the picture flips completely. Physical silver isn't following the paper script. It's vanishing at an accelerating pace. COMEX registered inventories have been draining relentlessly. Outflows in the millions of ounces during these violent sessions alone, as bars get pulled for delivery and shipped out. Shanghai futures show the same story. Massive volume traded, but the physical metal backing those contracts is getting scarcer by the day. Dealers worldwide report bars and coins flying off shelves the moment prices dip. Retail buyers in the West stacking aggressively on weakness, while in Asia the demand is outright ferocious. In India, premiums on physical silver surged during the dip, with Mumbai buyers paying well above spot to secure coins and bars for jewelry, investment, and cultural demand. Southeast Asia saw retail go gangbusters, ignoring the paper carnage and loading up, because lower prices mean better entry points for long-term holders. Industrial users, solar panel makers, electronics giants, EV battery producers haven't paused for a second. They need silver now, not in paper form, and they're taking delivery regardless of futures volatility. Global industrial consumption keeps climbing toward record levels in 2026, driven by clean energy mandates, AI infrastructure, 5G rollout, and semiconductors that devour ounces by the ton. This is the classic decoupling. Paper silver gets printed, shorted, leveraged to infinity through derivatives and unallocated claims. One big coordinated push lower, spoofed orders flooding the book, algorithms triggering stops, and boom, price crashes to flush the weak. But physical silver? You can't print bars. Mine supply stays flat or declines. Major producers in Mexico, Peru, China facing higher costs, regulatory hurdles, and declining ore grades. Recycling helps, but not enough to close the structural deficit that's persisted for years and widened dramatically in 2026. Forecasts from major banks point to annual shortfalls in the hundreds of millions of ounces, with no quick fix in sight. When the paper market gets slammed like this, it doesn't extinguish the bull. It purges excess leverage, resets sentiment, and hands discounted metal to those who understand the game. The panic sellers exit, often at a loss, while the prepared accumulate quietly. Asian buyers, central banks quietly building reserves, institutions swapping paper for physical, they all see the same thing. Scarcity underneath the surface noise. History backs this every time. The big runs in precious metals, whether gold in the 1970s, silver in 2011, or the explosive moves in recent years, always feature these brutal corrections. The flush clears the board, builds basing pressure, and when suppression lifts, the rebound is ferocious because the fundamentals haven't changed, they've strengthened. Physical demand outpaces supply more with every dip. Premiums in real markets stay elevated or widen, and the divergence between paper fantasy and physical reality grows impossible to ignore. The crash was engineered to create fear, But fear is fuel for the next phase. Those dumping now are handing over metal they'll regret losing. The ones staying stacked, adding on weakness, positioning for the squeeze, they're the ones who win when reality reasserts itself. Physical is the anchor, paper is the storm passes, the anchor holds. And when it does, the move higher isn't a recovery, it's a detonation. So, there you have it. The 22% silver plunge in just 2 hours was no mystery, no random glitch. It was a classic paper market flush, engineered fear, leveraged liquidations, spoofed volume, and weak hands getting shaken out so the real players could reload at bargain prices. The fundamentals haven't budged an inch. Physical demand is roaring, Asia stacking, industry hoovering up every available ounce, vaults draining, premiums spiking on dips, structural deficits widening. Paper can crash overnight. Physical silver can't be conjured out of thin air. Every major bull market in history has these violent corrections right before the next explosive leg higher. This isn't the end, it's the setup. If you're still holding, stay strong. If you're watching from the sidelines, this is your window. Don't chase when it's ripping 100 plus. Buy the fear when they hand it to you discounted. Stack physical, ignore the noise, position ahead of the squeeze. The manipulators win short-term battles. Reality wins the war. If this breakdown helped you see through the chaos, hit that like button so the algorithm knows to spread the word. Drop a comment below. Are you adding more silver on this dip, or did the crash shake you out? Let me know what you're stacking, what your average is, or what you think happens next. Gold, silver, both? Your thoughts fuel these talks. And if you're not already subscribed, smash that subscribe button and turn on notifications. These kinds of moves happen fast, and I break them down live. No fluff, no filter. Just the raw truth on what's really moving the metals market. Don't miss the next one. Stay stacked, stay sharp, and I'll see you in the next video.